Good afternoon. Thank you for joining us again on this afternoon. Our webinar will start in just a moment. We'll let you all settle in, but in the meantime, just note on your screen if you have any questions or feedback for the Chamber, please send them to info@windsor-essex-chamber.org. For COVID-19 updates and other helpful resources, visit our website and there is a COVID-19 tab. As well, we update our social media daily. You can follow us on Twitter, Facebook, LinkedIn, and Instagram. As well, you can see our previously recorded webinars on our YouTube channel, which is also linked on our website. Just keep a note that this webinar will also be recorded today and made available for viewing later by the end of this week. And if you have any questions for our guest speakers, please drop them in the chat or Q&A, and we will monitor and take those up at the end of the presentation. So at this time, I'm going to hand it over to our President and CEO, Rakesh Naidu.
Thanks, Marina, and good afternoon, everyone, and welcome to the Business Briefs Interactive Seminars, webinars, I should call them. So as most of you know, we are still in stage one, looking forward to getting into stage two, but we do have some way to go. Our number of infections, in terms of new cases, there has been 6 more. That's the latest count. We also have, in terms of total number of deaths, thankfully that number hasn't changed since quite a few days. So that's a really good thing. In terms of total confirmed cases, we are about 1,244. Resolved cases about 721. So overall, the numbers are low, except for some recent outbreaks that we've had. And as of today, I think there is 8 outbreaks, workplace-related outbreaks that are active, 3 in Kingsville and 5 in Leamington. So hopefully, we'll be able to resolve things soon, and we'll be able to get into stage 2. So I know everyone is very keen and looking forward to that, and so is the Chamber. From the federal government, there's 2 things that I wanted to point out that may be of interest to you. Number one, the Prime Minister announced that there is going to be a national contact tracing app that will be made available soon. It'll be a free download, and I think it should be available in the next 2-3 weeks. I think that's a step in the right direction. It is going to help us in ensuring that we keep track of people that are going to be potentially infected, and there's a way to track them, and there's a way to contain and to inform the local health authorities if in the event there is someone that has got infected. So using of technology and that app is definitely a step in the right direction. The government is expecting that more people will download it so that it becomes effective. And when asked, the Prime Minister said that a number of 50% and above in terms of download and use would be a good number, and that would give us good results. So encouraging everyone to take a look at that app. Of course, we don't have a lot of information today, but once we have that, we will have a better insight in terms of how useful it will be and if there's any concerns. So stay tuned. We'll be mentioning, or we'll be talking about this in the next few weeks as well. And a program CEBA, which most of you know, which is the Canadian Emergency Business Account, that is being tweaked. Tomorrow, they're going to release more information. And this is for those businesses that have not been able to qualify as yet for the business account. So if you are a small business that, because of the current eligibility criteria, has not been able to tap the $40,000, the $10,000 of which is non-repayable, then you may want to take a look at the news coming out tomorrow. The federal government is trying to make it more inclusive. So we are very hopeful that this will include many more businesses into the eligibility criteria. And then locally, as many of you know, that we have launched the Shop YQG program, and this is in partnership with the Tourism Windsor-Essex PD Island, TWEPI. This is a program to support our local companies, our local businesses. And it is very important at this time that we do, as we reopen. Once we reopen, we need to be there to provide support for our local companies. And that is one way of recovering fast from COVID-19. So we are counting on everyone's support. Details about this program is on our website, on Professi's website, and the hashtag is ShopYQG. So if you're shopping locally, if there's a business that you want to support, if there's a business that you want to have a conversation on, please post about them, go visit our website and there's more information about the program. So that's on ShopYQG. And today, we will be talking about the real estate industry, and we'll be talking about incorporation and why real estate professionals need to incorporate. Bill 145 has been introduced. There's a royal assent as yet, and we'll be talking more about this industry, which is a very important industry. It contributes significantly towards the GDP, not just of the region, but of the country as well. So I wanted to share a little bit of the trends and the information that we have seen, something that all of you, especially if you're in real estate industry, may be quite aware. But just wanted to highlight that, the home sales month over month in May rose sharply by about 57%. So that's good news, though, as year over year number is still down as compared to 2019, but still I think it's a step in the right direction. Also, in terms of number of properties that were listed, that there was an increase of roughly about 70% from April to May. And locally, the average home price has gone up by 14%, and this is year over year, which I think is another good trend. There is definitely an increase from April to May, but year over year, so comparing 2019 May and 2020 May, there's still a 14% increase. So that's, I think, is definitely a step in the right direction. At the beginning of the year, there was a significant increase in the average home sale price of close to, I think, about $70,000 or $75,000. And then, it was a seller's market. It was red hot market, and then COVID hit and sales slumped and the value dropped. But now we're seeing an increase, and hope this trend continues. So looking forward to seeing more information come out on that, and we'll be tracking this very closely. So today, Bill 145, as I mentioned, important topic, and this is, I think, would be of interest to many of you, those who are into real estate, whether or not you should incorporate now that, Bill 145 will be implemented. So what is Bill 145, why you should incorporate, what are the pros and cons of that? We'll learn about all of that today, and from two experts, local experts that are very well known. Jennifer Shilson, as many of you know, she's a very successful lawyer in her region. She's a principal with Miller Canfield. She's also a very strong supporter of the chamber. She's a Gold Circle member, and she went to the law school of University of Windsor. So a Windsorite, a very successful lawyer, and very, very informed lawyer. So, we're very delighted to have her, speak about this topic. And joining her will be Sandy Anderson, who's with Grant Thornton. She's the regional leader for Southwestern Ontario and is also a partner in the domestic tax group. She's based here in Windsor. Again, a Windsorite, and again, a subject matter expert that we're very lucky to have today in this webinar. So two very well-informed individuals that will provide you a great insight in terms of Bill 145. And, what we will do is we'll turn it over to them. They'll do a presentation. And then at the end of the presentation, we will open it up for some questions from you. So if you have questions at any point of time, feel free to put it on the chat box. We will make sure that we take note of that, and we'll go through the questions right at the end. So with that, I'm going to turn it over to you, Sandy.
Okay. Okay, can everyone hear me? Jennifer, is it on? Okay, great. So good afternoon, everyone. Jennifer Shilson and I are very excited to speak with you today about Bill 145 and what professional real estate realtors need to know about incorporation. Before we get started, how big of a change is this that's coming for Ontario? How many realtors do you think are currently registered in Ontario? Can you take a guess? Our recent statistics show there's approximately 86,000 registered real estate professionals located in Ontario. 67% of them are in the GTA area and 18% in Southwestern Ontario. I believe that there's close to 1,200 real estate agents registered with the Windsor-Essex Real Estate Association. So this is a really big change that's coming through the pipeline. Jennifer and I today are going to talk to you about background in legislation with respect to the personal real estate corporations, advantages of incorporation, investing in real estate, and how we can be of help here at Grant Thornton and Miller Canfield. So I'm firstly going to turn it over to Jennifer to take you through some background in legislation.
Thanks, Sandy, and welcome everyone. I think the place to start when we are talking about this new opportunity is by taking a little bit of a look back. Other professionals in the province of Ontario have actually had the ability to incorporate their professional businesses for a number of years. That includes professionals like doctors, dentists, lawyers, and accountants, but real estate professionals haven't been to date, despite the fact that for a number of years there have been ongoing discussions about opening up that opportunity for real estate professionals. With respect to the professionals who've been able to incorporate in the province, they've been taking advantage of it for a number of years. And right now, as we speak, 6 other provinces in Canada allow their real estate professionals to incorporate personal real estate corporations. And so Ontario is lagging behind when it comes to incorporation of real estate professionals. And fortunately, the province has decided to play a little bit of catch up. So Ontario is going to propose to catch up to the other jurisdictions with Bill 145, which is now actually passed into law, and it was known as the Trust in Real Estate Services Act. It is actually a piece of legislation that amends the Real Estate and Business Brokers Act. So if you have familiarity with that regulating piece of legislation, parts of it are still in place, just amended by this new legislation. The new legislation covers a number of different concepts. It has consumer protection provisions. It deals with amendments to codes of ethics governing real estate professionals. It clarifies, expands, specifies some of the powers of the Real Estate Council of Ontario. Our topic for today, it permits real estate professionals to incorporate personal real estate corporations. And there are also some issues with respect to reducing some of the regulatory burden facing real estate professionals. So we have this opportunity. What is this thing that you'll be able to create? A personal real estate corporation under the legislation is actually defined as a corporation that meets prescribed criteria. So the legislation at this point is not particularly informative on exactly what a personal real estate corporation or a PREC is, but we can look to other professionals, we can look to prior versions of the legislation to give us a bit of guidance as to what a PREC is. And it is a form of corporation like any other corporation in Ontario, so a similar formation process. We are anticipating that it's going to look very much like professional corporations for other professions, which are formed under the Ontario Business Corporations Act. So they're a formation of provincial law. Generally speaking, these professional corporations are specifically formed by members of the relevant profession. It's a form of corporation that is used to carry on only a certain type of business, whereas other kinds of corporations can carry on any business or conduct any activities. And generally, they're only meant for members of a specific profession. So, for example, and we'll talk about this in a bit more detail, there are often, in the context of the prescribed criteria, things like limits on who can own shares. So now we kind of know what it is. Why is this big news? What's the big deal with this new opportunity? Incorporating will allow real estate professionals access to certain management and operational flexibility, and there are specific advantages that are not available if you're carrying on business as a sole proprietorship or in some kind of a partnership. And we need to wait for some of the regulations which are not yet ready in order to better understand exactly how much flexibility we're going to have. So the regulations that we're sort of anticipating will spell out what the corporation actually can look like. If we look at past drafts of the legislation, they included things like they would specify who can actually own shares of a PREC. So it might be registrants with the Real Estate Council of Ontario. It might be their family members, holding companies, trusts, either family trusts or trusts for minor children. Often there are limits for professional corporations on who can serve as officers and directors. There's almost always a restriction on what kind of activities the corporation can carry on. And there are usually very specific naming conventions. So for example, you might have to actually have the words personal real estate corporation in the name. And I'll talk a little bit more about that later. So we know what they are. We know why they're a big deal. What are the advantages of actually incorporating? And I'm going to start with a general overview of the advantages, and then I'm going to speak about the limitation of liability and then turn it over to Sandy to talk about what I'm sure everybody is here for, and that's the tax scoop. So the advantages for incorporation include limitations on certain kinds of liability, the potential for income tax deferrals, access to capital gains exemptions, flexibility for Canada Pension Plan, income splitting opportunities, and also some opportunities for real estate investments, provided that you're mindful of some of the traps that can be out there. So Sandy's going to cover the tax part, and I'm going to go on to the limitation of liability before I turn it over to her. A corporation, any corporation, one of the big advantages is that it can act as an insulator when it comes to certain kinds of liability. Because a corporation is a separate legal entity and it can conduct its own business, generally speaking, in Canada and in Ontario, the law doesn't prohibit, but generally speaking, courts will not look through the corporation and impose liability on shareholders, officers, and directors. So if you buy shares in a company or you hold shares in a company, your starting point is that your liability exposure is to the extent of your investment in that company. But if, for example, the company doesn't pay an invoice, the shareholders are generally not liable for that. There are exceptions to that nice little wall that is created by all corporations, including PRECs, and those are liability for professional misconduct, errors, and omissions. And in some cases, there is also liability which can flow to directors for certain things like tax remittances, but I'm not going to focus on that. The important thing for you to know is that by incorporating your professional real estate business, you don't escape the liability that you would have with respect to your professional services. So any professional, this includes lawyers, accountants, we remain liable for our professional errors and omissions, despite the fact that we may use a corporation to conduct our practice or our business. So that liability will flow through despite the use of a corporation. And personal real estate corporations, our expectation is, if they're like other professional corporations, would also be subject potentially to investigations or allegations of professional misconduct from their regulatory body. And that can lead to discipline for both the corporation or for its shareholder, broker, or agent. So you do have to be mindful that having a corporation isn't an absolute protection from all kinds of liability. And there are still ongoing regulatory obligations that can't be avoided for the use of a corporation. So I'm going to turn it over to Sandy now to talk about more of the advantages.
Thanks, Jennifer. So anytime somebody comes to see us and they ask about incorporation, often they do know about the limitation of liability that Jennifer just talked about. But the next thing that they wanted to know is, how much will this save me? So we're going to talk about the income tax deferral that is available if you run your practice as a real estate professional through a corporation rather than a sole proprietor. So what I'd like you to do right now is to think in your mind or write down on a piece of paper, what was your net revenue last year from your business? Now I'd like you to think about, how much money in your personal budget do you actually need to live on after tax? Now compare that number to the first number. If you have a gap, then incorporation may be right for you. Because what happens is, any money that is earned at the corporate level that is not removed personally, you can achieve a deferral of income tax. We usually have to explain to people potentially looking at incorporation that this is just a deferral. If you choose to tax all of your revenue inside of a corporation and then need all of that money to live on and take it out as a salary or a dividend, there really is going to be no tax advantage to you to incorporate, because the way that the Tax Act works and the government knows, it's called integration. So they try to make it that after you withdraw the money, you're in the exact same tax position as if you would have earned it as a sole proprietor. So the really big thing here is this income tax deferral. So we have on this slide here, the corporate tax rates. They've really come down over the years. So basically, if you incorporate and you now earn real estate commissions inside of a corporation, on the first $500,000 of net income after expenses, your tax rate is going to be 12.2%. If you have any income over $500,000 or already share the small business deduction with another entity that is associated, then the general rate comes in of 26.5%. Now let's compare that to the right-hand slide, where in Ontario, for income over $220,000, the high marginal rate is 53.54%. So we're looking at almost a 40% tax deferral at the small business rate. And what this does is it will leave you with more money to invest for your retirement or to accumulate wealth preservation. So basically on the left-hand side, if you're operating as a sole proprietor, there really is no opportunity for a tax deferral other than perhaps saving in an RSP. So basically all of the business income that you earn gets reported on your personal tax return, which I'm sure you're well aware every year when you see that tax bill. As on the other side, if you're incorporated, the income is earned down in the PREC level. It's taxed at those lower corporate rates. And then you only pay tax when you need to remove the money from the corporation. So you actually have some control here as to that personal layer of tax. There can be even some savings instead of it just being a deferral, if when you later on remove that money from the corporation, perhaps because you're retired, you may have a lower tax bracket. So in fact, there is a pure savings. But it is all dependent on what the current rates are at that time when you remove the money from the corp. So let's take a quick look at an example here. So if we have Justin, a realtor in Ontario, and his average annual income after expenses is $300,000, but the cash he needs to live on is $100,000. Justin might be interested in investing in real estate properties with this extra money saved through the tax deferral in incorporation. So this is what it would look like. Previously, when Justin was not incorporated as a sole proprietor, he would report $300,000 of income on his personal income tax return. He would pay approximately $121,000 of personal tax. And of course, the CPP, being a self-employed individual, you're responsible for both the employer and the employee side of the CPP. Right now, the maximum is $5,796. Justin also needs $100,000 to live on. So as a sole proprietor, The remaining to invest would be $72,878. Let's contrast this if Justin earned his $300,000 of commission revenue inside of a PREC. The corporate tax at 12.2% would be $36,600. Again, he needs $100,000 to live on. The dividend tax would be $26,597, so therefore his dividend does need to be $126,597. This remains cash in at the corporate level of $136,803 compared to the $72,000. So you can see here, there's quite a large savings for Justin to be able to invest. Now this is going to change depending on everybody's personal situation. So those numbers that I asked you to take a look at and write down, what is the amount that you earn from your business? And what is the amount that you need after tax to spend? That's the amount that we're looking at to defer tax on. And that deferral will just depend on what income tax bracket you're in. So we'll talk a little bit more about the taxation inside of a corporation when we get into the different real estate investments. But let's go over a few other advantages that can be had from incorporating your practice. You may have heard of the lifetime capital gains exemption. So a lifetime capital gains exemption is available to all residents of Canada, and the amount for 2020 is $883,384. So basically, this exemption can be used if you own shares of a private corporation and you're able to later on sell those shares. Now, in a real estate market, you may or may not build up a practice that is saleable. You might have a lot of personal goodwill where people know your name and reputation, but that might not be something that other people are willing to purchase. It may well be though, if you've accumulated a team, perhaps are a broker yourself and have a name that you can operate under. So basically the primary conditions to be able to access capital gains exemption is there needs to be a sale of shares, and the shares need to have been held for 2 years, and the underlying assets in that business need to all be primarily used for the last 2 years in active business income, and at the time of the sale, about 90% needs to be used in active business income. So something like unbooked goodwill would be entered into that calculation. So there is an opportunity if you can ever sell your professional corporation later on to achieve this exemption, but it may not be an immediate benefit that you would see right now. So I mentioned when we were going through those numbers about the Canada Pension Plan. The Canada Pension Plan, as a sole proprietor, you do have to pay, like I mentioned, both halves of the CPP. Right now, the insurable earnings is set to be increasing over the next few years, and actually will go all the way up to about $95,000. So this employer portion and employee portion at $5,796 that you're currently paying on your personal tax return is going to continue to increase. Now, when people incorporate, we mentioned perhaps taking your after-tax money that you need to live on out as a dividend. Dividends are not subject to CPP. So there's a little bit of good and bad about that. The good is that you have a little bit more control over your investments. Example, you could take that $5,796 and you could invest it in the stock market. You could invest it in other real estate. So you basically have control over how the money is invested. A downside might be something that you invest in may lose value over time, and it's not guaranteed like a government pension plan would be. However, when there was a lot of discussion a few years ago about these CPP rates increasing, there was a study done by CIBC, and it took a self-employed individual from age 25 working till age 65, contributing the maximum to CPP at that time, starting to draw out at 65 until the age of 82. And the rate of return on their money in CPP contributions ended up being 0.41 of 1%. So there's a lot of business owners who choose to take a dividend strategy rather than the Canada pension. This is individual to you. And with a corporation, you have flexibility to choose whether or not you want to take your remuneration out as a wage, as a dividend, or just leave it in there and defer the tax altogether. Now, with respect to the CPP, you might say, I'm going to switch right away to a dividend strategy. We do have to be careful if you have childcare expenses, because childcare expenses are deductible by the lower income spouse or partner, and they do not count dividend income as earned income. So you could, in fact, if you only had dividend income, as be considered the lower income spouse and lose all of your childcare expenses. So we sometimes pay a little bit of a wage, maybe not a full wage, depending on how much your childcare expenses are. You will no longer accrue a RSP contribution limit if you do not take a wage. So that might mean that you have excess room right now, but once it's filled up, you will not be generating any more room. However, people do tend to invest inside of their corporation, so that's not usually an issue. And again, once you stop contributing to CPP, there is, of course, an impact on the money that you later on are able to withdraw under that plan. So those are just some of the remuneration planning items that we take a look at when people are incorporated. Now, you might be thinking, can I income split with anybody else? I might have a spouse who's a lower income earner. Is there any opportunity here if I incorporate to be able to income split with a family member? So as Jennifer mentioned, there's a lot of regulations right now we don't know that are still out there unclear, waiting to be done. We don't know who's going to be able to be a shareholder of the PREC for real estate professionals. And even if spouses are allowed, in 2018, new rules came on board to severely restrict the payment of dividends to shareholders who are not active in the business. So we do have a number of rules that we have to work around, but there still are opportunities to income split. You just have to sometimes be a little bit more creative. For example, that capital gains exemption that we mentioned, if the shares qualify for that, we can do a series of transactions to put income in a spouse's hands. Other than as a dividend, we can create a capital gain. If the shares qualified for that exemption, these tax on split income rules would not apply. Also, you may accumulate a lot of your wealth inside of the PREC and then retire. When you hit age 65, you actually can income split with a spouse, and these tax on split income rules no longer apply. So there is some opportunity there to do income splitting, whereas as a sole proprietor, you earn the money, it gets taxed to you on your personal tax return that year, all the taxes paid up front, no opportunity for deferral. So let's take a deeper dive into your market and what you're most familiar with, and that's investing in buying and selling real estate. So right now, there is nothing stopping anybody from buying real estate, fixing it up, selling it inside of a corporation, and earning that as active business income at that 12.2% low corporate tax rate. In fact, some of you already right now might have a corporation that you do this with. Sometimes real estate agents, though, will buy properties. They like to live in them for a little while, then sell them, and try to claim the principal residence exemption, which can work unless you're doing it quite frequently. Canada Revenue Agency could challenge whether or not that is eligible for that exemption. But even if you're not getting the principal residence exemption, if you are buying and selling and flipping real estate, people will sometimes say, well, I want it to be a capital gain because the rates are lower. This is if you are not incorporated. The whole game changes when you're dealing with corporation. So let's take this deeper dive and see these different revenue streams, what they look like inside of a corporation. So it's important to note that the tax treatment does vary for buy and hold. That means you buy a piece of real estate and you hold it to rent it out, versus buying it, wanting to fix it up, and immediately selling it for a profit. We're going to call that flipping. So the first column we have is real estate flipping, business income. So the first line, the upfront tax, the small business rate, is if you do that revenue flipping inside of a corporation, you can on the first 500,000 get that 12.2%. If you are already above the 500,000, it'll be at the 26.5%. And then when you eventually flow the remainder out as a dividend, you're very close to the high personal rate. Again, this just depends. This is all of these examples using the high marginal rates, 53.54%, 54%. Okay, so business flipping income, still a lot of opportunity for deferral there on that income to buy more properties. If your strategy is instead to buy and hold, and you later on sell that property that you rented, any accretion in the value will be taxed as a capital gain because you purchased that property in order to earn income, being the rental income. So there's two components here. There's the rental income itself, and then there's the accretion in value, which is the capital gain on the eventual sale. So a capital gain inside of a corporation is automatically taxed at 25.1% upfront. It's the same rate, whether it's a general rate or a small business rate. That concept does not apply. The flow-through rate on a capital gain, however, is quite low because in Canada right now, only capital gains are only 50% taxable, which is why people tend to generally prefer a capital gain rather than regular business income. A little bit more tax up front, but lower tax on a flow-through into your hands personally. Now the real trick, and if you have a PREC and you're going to start to have some buy and holds, the real trick is the rental income. The rental income is taxed a lot differently inside of a corporation than people may realize. So the small business deferral of 12.2%, the government only wants that on active business income to allow people to retain money in order to invest in capital, generate jobs, create growth. They do not want any of this tax advantage or deferral to be on what we call passive income. Passive income is things like rents, royalties, interest income. So if you took $1 million and put it inside of a corporation to invest it, you're not going to get the 12.2% tax rate. It'll be immediately taxed at 50.2%. Now, because that's not fair to tax it at that rate, and then again, when you take the money out, there is a refundable portion that gets triggered when you pay yourself a dividend. But the actual flow-through rate between the leftover corporate tax and the personal tax at high marginal rates has a very high flow-through tax cost. You'll see on here is 57.9%. So you will want to take all of this into consideration when you're choosing what to do with all of this extra investment you may have from generating tax deferrals by incorporating. So when we just talked about a capital gain versus business income on flipping real estate, what are some of the factors that Canada Revenue Agency looks at? They will look at the nature of the property sold. So was it perhaps your cottage you used up in cottage country for personal use? Was it a rental property? Or was it something you bought and held for a very short period of time, fixed it up, and then sold it? So the length and period of ownership is looked at. Also looked at is the frequency of similar transactions and the expertise of the taxpayer in that market, being perhaps real estate professionals. They look at the work expanded or relatable to the property. So did you buy it, fix it up? And there is this motive and intent when you first purchased it. There's a primary intention and a secondary intention. Intention is very difficult to show. So if your secondary intention was always to sell it, even if you bought it and hold it to rent it, there is an argument CRA could make there that that is in fact business income, an adventure in the nature of trade, not capital gain. So we get that question quite a bit. Is it capital gain? Is it business income? These are some of the factors historically that Canada Revenue Agency has considered. So let's take a little look here. I mentioned that right now there's nothing stopping you from having a flipco company and having those active business rates if you're claiming your buys and sells as regular business income. So now that you're able to have a personal real estate corporation, what you want to consider is that small business deduction, because everybody likes that 12.2% tax rate. So if you happen to be wanting to invest in that flipco property with another party, there's actually an opportunity here. So in this scenario, Justin has his personal real estate corporation. He may then desire to purchase a property, fix it up and flip it, and he's got somebody else who's willing to put some capital into that venture. So Justin and this third party, unrelated in this instance, may incorporate a flipco company that they each own 50%. Because Justin does not control that flipco, flipco will not be associated with his PREC. And in fact, in this scenario here, each corporation can receive the $500,000 small business deduction. So that can be very handy. Now, a little trap is you might already have a flipco. You might own that with someone related to you as a spouse. It might be your company that you want to continue to use for that in your personal real estate corp separately. If your personal real estate corp ends up associated with another entity, that 500,000 small business deduction does need to be shared. So if you're using 300,000 on flipping 1 year because you had a big sale, you're only going to have 200,000 left for your real estate commissions in that year. The small business deduction is given annually. So if you're not buying and selling all the time and it's every couple years, you'll just need to be aware of that, and you'll need to consider that buying and selling, is it business income or is it capital gain? Now, when we just said you have to consider if it's business income or capital gain, this is very important. So is the buy and hold in your rental income. Because just a couple years ago, the Liberal government introduced another tax measure. They actually were not real thrilled with how many people were taking advantage of this 12.2% large deferral. So they came up with some new rules that if you earn passive investment income inside of your corporation or any corporation you're associated with, they will start to grind back your small business deduction. I guess the logic there was they felt that you were no longer a small business corporation if you had enough money to invest. So how this grind works is if you have $50,000 or more of passive investment income, again being rents, royalties, capital gains, then the access to your small business deduction starts to get ground down. It's ground down all the way such that after 150,000 of passive income, you get no small business deduction that year. So it's basically ground down $5 of small business deduction for every dollar of passive income. So you really want to consider what are you doing with the excess cash that you now have to invest at the corporate level. So in this is a little tip. Again, you could be investing in a buy and hold, and if you create a separate entity to do so with an unrelated party, and you each own 50% of the votes and the value, that company will not be considered associated with your PREC, because in this case, Justin is not associated with the other shareholder and does not control the buy and hold co. So you could have as much rental income in buy and hold co as you wanted. You can sell and have as much capital gains as you want, and it will not affect your access to your small business deduction. So a lot of times people do have other parties that they're investing with for capital. You're going to want to consider this in your structure. So let's look at another trap. So the small business deduction, as we stated, is eliminated or ground down through investment income in an associated entity. So you may, just like the slide before, this one is okay, 50-50. Slide after, if Justin says, well, I want to have control, I don't mind having another party as a shareholder, but I want to be able to control and have complete rights over when we buy and sell the underlying properties. And if you mistakenly set it up 51-49, in this case, all of that passive income is going to grind down your PREC small business deduction. So structuring is very, very important. Ratios, types of shares, votes. Here's another scenario that sometimes might happen. Justin might have his PREC. He may know another agent that has a PREC themselves. They might say, hey, let's go together in a joint venture and invest in a property that we can either flip, buy, and hold. In this case, we're going to consider flipping. So in scenario one, the third party will definitely get their small business deduction in their corp, and so will Justin. So two small business deductions, 500,000 each. That's not bad, okay? Joint venture or partnership, they'll each earn their share of the FlipCo income in their PREC, and it'll be part and parcel of their 500,000. So not bad, scenario one. Even better, scenario two. Let's have those two unrelated parties, Justin and third party, create a FlipCo. Now, FlipCo's own 50-50. It's not controlled by either one of them. In fact, FlipCo's not related to Justin's PREC or third-party PREC. In this instance, you actually just generated access to 3 small business deductions. That's 1.5 million of business income that could be subject to tax at 12.2%. Trap, however, might be you have a spouse with an operating company that you're investing with. You have Justin, and you might think again, let's create a third company to get 3 small business deductions. Because Justin and spouse are related, what happens here in scenario number 2 with Flipco in between is you just associated all 3 companies. So rather than scenario 1 where there's 2 small business deductions and that low rate of tax, scenario 2, you just associated everyone, now they're sharing 1 small business deduction. So again, previous slide, unrelated parties, scenario 2, 3 small business deductions, related parties, scenario 2, 1 small business deduction. So by this time, your head is probably spinning. Passive income, small business deduction, Flipco, Holdco, buy and sell. I know, it's very complicated and there's a lot of different rates of tax that come into play. And so that's where we really want to be of help and hear what are your goals and plans and how do you want to be investing for your future. Now, some of you, after you just had your head spin, might just say, forget it, I don't want all of those and I don't need all of those. I just want my PREC to get my commission income at a lower rate, and I just want to buy and hold and some real estate inside my PREC. Sandy, can't I just do that? It looks way too complicated the other way. Yes, you can, and that may well work for you. It just depends on the level of income that you're earning and the type of income. Again, rental income is going to be taxed at a really high rate up front. The other thing to remember is if you do a buy and hold in your PREC, if you invest in passive assets, it can jeopardize, again, the ability to claim the small business deduction, but it can also mess you up for that capital gains exemption that we previously talked about, where the assets of the underlying company need to be generating active business income, whereas rental income does not. Okay, so after all of that, I'm sure you're all very excited to run out and get a PREC. So I'm going to flip it back over to Jennifer so that she can talk to us about what are the actual steps involved. How do I go get me one of those?
Thanks, Sandy. That was really helpful and a lot of great information. So I think we've covered a lot of advantages and took an opportunity to avoid some traps. So I'm going to walk you through just briefly the process of incorporation in case you haven't been through it in the past, and then give you an idea of where some of the costs lie associated with incorporation. The first step really in incorporation is to select the name that you want to use. And as I noted previously, we're expecting that there's going to be some restrictions with respect to how you name a PREC. And we expect that you're likely to have to use the words personal real estate corporation or the French version of that name as part of the overall corporate name. If you look at other professionals, often, for example, they're required to use some form of their surname or their full name along with, professional corporation. In this case, it would be personal real estate corporation. So selecting the name, number 1, we get that cleared and make sure it's available for use. And our next step is usually to work with your tax advisors like the folks at Grant Thornton to plan the share structure and share attributes. And the share structure is really the kind of shares that can be issued to the various shareholders who are permitted to actually own shares in the corporation. And it's important that we work with your tax advisors on this because the share attributes are usually done with very specific tax planning in mind. Generally either estate planning goals or goals with respect to how we're going to get money out of the corporation. Once we have that share structure established, our next step is to draft the articles, and that is a tag team effort between legal and usually tax to make sure that we are achieving all of the tax goals and still meeting the legal requirements that might be set out in the regulations with respect to the PREC. Once we have a set of articles that we're all happy with, the name is reserved, we've specified the registered office address, we can file the articles of incorporation electronically. We basically push a button and presto, you have a company. Once we have the company, we prepare organizing documents, which are sort of a standard form, obviously customized for each corporation, but they're a standard packet of documents that appoint officers, directors, select a year end, confirm whether the company is going to need an audit or not, usually appoint accountants, lawyers, and bankers. And we prepare that, and generally we would send that out to you along with whatever is the registration package, so that the PREC is actually qualified to carry on business either as a broker or a salesperson. So that part of the process is still a big question mark. And in part, that's because the infrastructure for that registration really follows on the heels of the regulations. So until we know what the regulations say, it's very hard for the regulator to produce that application package. If we look at what is required of other professionals, they have to, for example, disclose the shareholders who are members of the profession. Usually they have to disclose the officers and directors, where the PREC will operate. So for example, if it's affiliated with a brokerage, that may have to be disclosed. And of course, there's always a fee. And that usually gets submitted to the regulator. They have a certain set of criteria that they look through, make sure the corporation is in compliance, and then they'll typically deliver a certificate that says the company can now carry on the business. That registration generally has to be renewed annually. So the incorporation process is actually quite painless, and there's some cost associated with it, but I don't think it's cost prohibitive. So the kind of costs that you can expect if you decide to incorporate are legal fees, and the legal fees are associated with preparing the articles, preparing the organizing documents, and often we prepare other documents that are necessary to allow the corporation to carry on business. So for example, you may have listing contracts or other sole proprietor assets that need to be rolled into the corporation. We would take your tax advisor's instructions and document those legal relationships. There are often also agreements whereby you contract with your new corporation to provide services. So that's part of the legal cost associated with it. There's also accounting fees associated with having a corporation. It has to be maintained, it needs financials, it needs tax returns, and it's going to need that upfront advice on structuring, which is really important. The disbursements are, the usual sort of your name search cost, government filing fees, a minute book, and then whatever the fee ends up with respect to registration of the PREC as a broker or salesperson. And when you have a corporation, the one thing that's really important to remember is it is a separate legal entity. So it has a sort of life of its own, and that lifespan is not limited. So once you form a company, it's out there and it doesn't go away if you decide that you're no longer interested in it. So companies need to be maintained on an annual basis. They need to have a package of annual minutes or resolutions, and the directors will, for example, approve financial statements, elect officers. The shareholders will elect the directors, confirm the appointment of an auditor or waive the audit requirement. So there's annual upkeep associated with having a corporation. Again, not complicated, not costly, but really important. And for those of you who are considering using your PREC, potentially, as Sandy discussed, as a vehicle to invest in some real estate, it's important to know that not too long ago, Ontario added an additional register requirement to its minute book requirements. And now corporations, all corporations, are required to maintain a register of ownership interests in land. And that register is sort of a package of documents that sits in the minute book, identifies all real property owned by the corporation, the date it was acquired, any date of disposition. Usually we have to have the municipal address, the land registry office division where the property is located, its property identification number, legal description, and tax assessment roll number. And there are actually penalties associated with failure to properly maintain that register. And I mention it because these types of PRECs may be really attractive for real estate investment. And I can tell you, I think the transition to having to maintain this register has been challenging for many corporate entities. So important to note if you're going to have a lot of real estate transactions using that corporation. We here at Miller Canfield, we have extensive experience dealing with professional corporations of all kinds. So we can assist with incorporation and registration, annual minute book maintenance, real estate transactions, the structuring that gets the assets from your sole proprietorship into your PREC, financing transactions, and the estate planning that comes along with having another corporate entity in your life. And so we are happy to and very experienced helping with all of that. I'm going to hand it back to Sandy now, and she'll tell you about what her firm can do to help as well.
Thank you, Jennifer. And, you know, of course, this is not just Grant Thornton, but any other, you know, advisors that you may have out there for tax or accounting. Basically, anytime you're going to consider a PREC, as we just went through, you're going to consider the cost versus the benefit. This may, after hearing us speak, be a little bit more involved than you had actually imagined. Sometimes you just need to live with the structure for a little while, and you need to understand the benefits. So where we can help is we can have an individualized consultation with you to help you run some numbers as to, again, those amounts of revenue you're expecting to have. What do you need to live on? Who are the shareholders going to be? What do you want to do with the money that is saved at the corporate level, and how are you going to be investing it? The other part that we really didn't talk about is once Jennifer's firm gets a corporation set up, we now need to transfer your actual practice and sole proprietorship into that entity. So during that period of time, you may actually have a number of real estate listings out there with your broker. And when you receive those commissions, you're going to want those commissions to be in your PREC at that nice 12.2% tax rate. So how can you get that revenue to be in there? Is there an assignment of income? Did you actually just transfer something of value being that listing? So what you don't want is to trigger a tax effect when you transfer that book of business in. So there is an election form that you can file with Canada Revenue Agency, and we'll assist you with that in addition with other tax filings that go along with incorporating a sole proprietorship practice, dealing with the HST, any HST that could be applicable on contracts rolled in. If you have an extensive enough business, we can help you with the valuation, but that may not always be necessary. And as Jennifer mentioned, not only is there the legal ongoing maintenance of the PREC, it being a separate legal entity, it has to file its own corporate tax return every year. So we can assist you with the compilation of your year-end financial statements and filing of your corporate tax return. As we work through with you on your taking a salary or a dividend, you may need to prepare a T4, T5. Bookkeeping assistance, there's some really great cloud accounting apps now that are out there that can help you, with receipts, scanning in, tracking expenses, automating everything to make your life simple. And for the tax planning side of it, really, again, it depends on if you're set up. We're going to do some remuneration planning. If you then have that extra cash, looking at structuring investments. How do you invest in that real estate? How do you move the money over to a separate flipco? Do you loan it? Do you loan it at interest? How do we optimize interest deductibility? All sort of tax issues that arise when you get to that stage. Buying and selling real estate properties, helping you estimate the amount of tax. Is it going to be capital gain? Is it going to be regular business income? And then, of course, estate planning. So I just want to thank you on behalf of Jennifer and I. We want to thank the Chamber so much for this opportunity to speak with everyone today. In a non-COVID time, we'd be seeing you face to face. We could see when you glaze over, when there's too much tax talk. But the one positive that's come out of this is we've all gotten, a little bit better at doing these Zoom meetings and get a little bit of interaction with you that way. So again, thank you to the Chamber for this opportunity, and we're happy to answer any questions that may arise.
Thanks, Sandy, and thanks, Jennifer. You did a fantastic job. It was very informative, and I'm sure that people who are listening will find it very useful and are thinking now seriously about the benefits of incorporation. Clearly, I can see there's pros and cons, but at least to me, it seems that there's quite a few pros. So, hopefully people have received this information well and they can act on it. But I also want to just, bring it to everyone's attention that if you do choose to incorporate, remember that the chamber can provide you additional benefits. You know, there are several programs that we offer to our members, members who are, you know, small businesses. That includes, you know, whether you're looking for, you know, someone to do your bookkeeping, or if you're looking for insurance products, whether it's, you know, health insurance, or whether it is auto insurance, or whether you're looking for someplace to buy your supplies. There's many different vendors that we work with, and we provide you the benefits of being the chamber member and offering you at a discount. So if you do, you know, get moving in the direction of incorporation and you're working with Sandy and Jennifer, come back to the chamber and we can help you further with the other services the chamber can provide. So with that, let us open it up to a few questions. Okay, where is there? Yeah. Okay, questions. All right. So the question that we have is, what if you're a dual citizen? Meaning, what if you're a Canadian and an American? How does it work?
Okay, I'll take that one. We get this quite a bit with anybody, any business owner. They're resident in Canada, but they happen to be a US citizen. So Canada taxes based on your residency, whereas the US always claims the right to tax based on citizenship. So what happens is you still need to file a US tax return and report your worldwide income if you are a US citizen. So there are foreign tax credits and things like that that you can have so that there's not double tax under the Canada-US tax treaty. But what happens here is if you have a personal real estate corporation and you're a US citizen earning commissions through that entity, before Donald Trump introduced these rules called GILTI tax, there was also subpart F tax for personal holding companies. And what happens is it takes away a lot of that deferral benefit because it will still tax a portion of it on your personal tax return. So we have to work with you. There are some credits in elections that you can make, and we really have to sit down and run the numbers and look at your scenario to see if it still does make sense. There will also be from the US some additional reporting because you'll own an interest in what to them is a foreign corporation. So there's some different filings that you have, and you have to be very careful because some of these forms carry penalties up to $10,000 for failure to file per year. So US citizens, we're used to working with that, but there are some special rules that have to be around that do affect the benefits.
Thanks, Andy. Second question again from Mark Eugenie, another good question. And he asked, what if husband and wife both are agents? Should they both incorporate or should just one of them and make both of them as shareholders of that one corporation?
Okay, good question, Mark. So that would just go back to when we were talking about the tips and traps and the access to the small business deductions. It'll really depend on that husband and wife, how much revenue they are generating from their real estate commissions. If they're under the 500,000, they may be able to just use one entity and that would not harm them. It would keep things simple. They'd still have the 12.2% deferral. However, if they were exceeding that or earning income from flipping properties at the corporate level as business income, you might want to look at each spouse having their own PREC.
Okay, thank you. The next question is, how is this different from current incorporation options available?
I think what that might be speaking to, Rakesh, is right now there's a lot of real estate brokers who are in fact incorporated. There are some agreements and arrangements that are able to be had specific to the brokers, that they're able to provide services through agreements and are not offside with their governing body. So in fact, it is not different. You would still have the same company. However, what might be changing is now as a real estate professional and these regulations coming on, I'm going to turn this over to Jennifer, you may actually need to take your current company and turn it into a professional corp by the guidance of your governing body. So the legal side, I'm not sure. From the tax standpoint, it is the same for brokers. Real estate agents right now, it's more difficult for them to fall into those same rules because they do not account for their income in the same manner. So brokers, probably the same. Agents probably haven't had as good access as they do now. Jennifer, do you have any idea from the current incorporations for agents, what might change for them?
Right. I think you kind of hit the nail on the head, Sandy. I think for brokers, there have been for quite some time a much wider range of options. But for an individual agent, they haven't had the same kind of options. To a certain extent, I think we need to see what the regulations come out and what they offer, because there are other professions out there, for example, pharmacy, where you can actually carry on that business through a corporation, but you can also incorporate professionally. And so we really need to see what those regulations will look like to see if PRECs in particular are offered any special status, or whether companies that are sort of right now out there who may be operating in that space have to sort of convert to this new form of operations. And it may be as simple as now you have to register that corporate entity if you're going to receive your commission income in that entity.
Okay, thanks, Jennifer. Next question is, why shouldn't I start my real estate investing with a corporation right from the start, even with a small investment? And is there any threshold for that investment?
Yeah, thanks, Rakesh. That's about, it goes back to that cost versus benefit. As we could see, you know, there's costs to get a proper structure, there's costs to incorporate, filing fees, and then there's annual costs, because not only will you have to continue to have your personal tax return filings, now you have corporate tax returns filings. So often people want to have a benefit to doing so, and because the professional liability is still limited, they may want to, for buy and holds, have that limitation of liability in there. So even though the tax savings is small, that could be a reason, but this is really going to be specific to every individual as to what their comfort zone and what they're looking to get out of that corporation is. If it's tax savings, then we do need to do a calculation, and after we include all of those costs, is there still as much savings as they had thought?
Okay. And I know we're running over, but maybe I'll take one last question here. And this is about, you know, the next steps. Maybe Jennifer, if you can help us with that. So where do we go from here? You know, there is a royal assent. What happens after this? And how quickly can one incorporate from here on?
Right. Thanks, Rakesh. So right now, the legislation has passed, but the devil really is in the details, as they say. And the regulations right now are at a point where they're in the process of consultation and drafting. So it's encouraging to know, for example, that OREA is advocating very strongly on behalf of agents, brokers, with respect to the incorporation process, to try to get as much flexibility so that there's a good financial outcome for all of the folks who might be able to take advantage of these PRECs. So there's, you know, they produce a paper, there's consultation with stakeholders, and ultimately that will translate into the final regulations. I've heard different dates on when the regulations might be available. Some I heard, you know, it could go into 2021. Some I've heard that the incorporation portion of the regulations might in fact be available sometime later this summer. And with respect to the incorporation portion of the regulations, because there were so many prior versions of this legislation, there was actually, like, if you were to look at the prior versions of this act or prior bills on this issue of incorporating real estate professionals, there was actually specific and very substantial guideline on what those entities would look like, what the restrictions were. So if they take that groundwork and run with it, at least on that part of the legislation, we might see regulations come out more quickly. Once the regulations are out, then I would expect the regulators to be able to move very quickly as far as being able to put together the infrastructure needed to process the applications. So hopefully maybe later this summer, we'll be able to get these things up and running, but we're sort of at the mercy of the consultation process for the drafting of the regulations.
Okay, thank you. All right, I think with that, we will conclude today's session. Fantastic information. Again, thank you to both of you for being here, for sharing this information, which I think is very exciting. I think it will provide new opportunities for our realtors here. And as I mentioned, the chamber is here to help you. There is a lot of opportunities for you to be part of the chamber, become a member, get into our network, find networking opportunities, whether you are a commercial realtor or whether you're residential or whether you have industrial properties. The chamber is a good place for you to network and find opportunities through our membership, and not just our membership, but outside of the network as well. So come and explore, how the chamber can help you as well. And with that, we will end today's session. Again, thanking Jennifer and Sandy for your time. And I wish all of you the very best. Stay safe, and we'll connect again soon. Take care.